So my base case is that the cycle's still in place, but that the cycles are changing over time. As Bitcoin becomes a larger market, so it's a larger, more liquid. We're talking a $2 trillion market now. It's more integrated with the traditional finance system rather than almost entirely disconnected from it as it used to be. I do think that some of the extremes are being removed from it. It's easier for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect.
When it comes to understanding Bitcoin and the broader crypto market, few voices are as respected or as precise as Alden. With a background in engineering and a sharp grasp of global macroeconomics, Alden has carved a reputation as one of the most insightful analysts in the space. She's not a hype merchant. She doesn't chase price predictions or viral narratives. Instead, her work focuses on fundamentals, liquidity, monetary policy, supply-demand imbalances, and structural shifts in global capital flows. In her latest interview with Cointelegraph, Alden shares her cautiously optimistic view of where this market could be headed. She believes a price target of $150,000 for Bitcoin is not only possible, but increasingly probable, especially when measured against current demand dynamics and broader macro tailwinds. But unlike the more aggressive bulls, Alden urges restraint. She doesn't commit to higher numbers just yet. Instead, she takes a step-by-step view, waiting for the data to confirm each leg of the cycle. Crucially, she challenges the popular idea that Bitcoin's fate is locked to a rigid 4-year halving cycle. In her view, this framework is too narrow. Market cycles, she argues, are driven more by psychological extremes, pockets of euphoria, followed by deep periods of depression, and by liquidity conditions across the global economy. What we're witnessing now, according to Alden, may be a longer and less extreme cycle, still bullish, but tempered by tightening credit, shifting investor sentiment, and maturing capital structures within the crypto space. So what's next for the market? In the next segment, Alden dives deeper into the fundamentals that matter most, breaking down why institutional flows, stablecoin issuance, and monetary tightening are reshaping crypto's trajectory, and what investors should really be paying attention to in the months ahead. Please watch, like, and share this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
So my base case is that the cycle's still in place, but that the cycles are changing over time. Even before this cycle, I published research kind of arguing that Bitcoin has correlated more closely with liquidity than anything else. Going back several years, liquidity cycles on average are about 3 years. And Bitcoin's bull markets, even though there's been like one bull market per 4-year halving cycle, the length of those bull markets varies. Sometimes it goes from lows to highs very quickly. Other times it takes longer. And that length of time is actually kind of correlated with what's going on with liquidity for the most part. And, as Bitcoin becomes a larger market, so it's a larger, more liquid, we're talking a $2 trillion market now. It's more integrated with the traditional finance system rather than, almost entirely disconnected from it as it used to be. I do think that some of the extremes are being removed from it. It's easier for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect. I do think that the 4-year halving cycle is increasingly less relevant because mining rewards are now a much smaller share of available coins. And instead, it's mostly about what price will unlock older coins. And so kind of the metrics that I track are, one, the market value to on-chain cost basis to kind of see, how much euphoria is in the market at a given time. And then I also track like the HODL waves. So generally speaking, when you have bull markets, the percentage of coins that haven't moved in more than a year or two starts to fall because some of those older coin holders that are deeply in the money now, they tend to start trimming into that strength. And we've been seeing it this cycle, just like past cycles. So I think the cycles, those cycles continue to matter, even as maybe the halving cycle matters a lot less than it used to.
Do you think we already reached the peak of this cycle, or you think there is still room to go?
So my personal opinion is we've not peaked yet. And going back to the prior kind of metric that I mentioned, market value compared to on-chain cost basis, the reason that's useful is you can picture, say, a house, like a street with like 50 houses on it. And let's say none of those houses changed hands in a while, and then someone buys one of those houses at a much higher price than it sold for last time. Generally what will happen is all houses on that street will go up in perceived price because one of their comparable sales changed. And yet a very small percentage of the houses changed hands at that new price. And so that's kind of in a liquid price. It's unclear what would happen if multiple people on that street, wanted to sell their house. And so not until you kind of are at that new price level for a while and there are multiple house sales, would you kind of consider that the new true price of houses on that street. And Bitcoin is obviously much more liquid than that, but it does a similar dynamic where if it jumps very quickly, with a pretty small number of coins that kind of changed hands and now we kind of reset the price of the entire market cap, that's not necessarily the real price if more coins want to move. And so that's why I look at the market value compared to on-chain cost basis, because when that gets really far ahead of itself, you're more likely to get a correction. And in the prior major cycle tops, including 2021, that ratio reached extreme levels. So basically, the market value increased way faster than the on-chain cost basis, and then it took a lot of time for that to be digested. When we look at this cycle, we've not reached anywhere near those prior peaks of metrics like that. We've kind of reached, say, mid-levels of that metric, and none of the metrics so far show anything of extreme sentiment like we see at prior cycle peaks, including 2021.
A lot of people might think that this is a sort of political premium that Bitcoin is enjoying at the moment. Do you believe that this premium exists? And if so, don't you think that it is not necessarily a sustainable premium?
I would view it as the opposite. It de-risked it slightly. So it took away a discount. And so basically when people and institutions invest in Bitcoin, they're pricing in some non-zero tail risk that the government's really going to crack down on it at some point. It's, even in recent years under the Biden administration, it's kind of been at the periphery of the market. In order to get the spot ETFs in place, literally the SEC had to be sued. And banks have been very restricted in what they can do with it. And I think the market correctly saw that in this current administration, that's less likely to happen. So they priced out a discount that was in. Now, obviously, in 3.5 years, some of that could be reversed based on election outcomes. That's a pretty far time away. And also, the bigger and more liquid the asset gets, the less relevant governments are for managing it, because at that point, the donors own it, the banks own it, it's tied in the financial system. So every kind of 4 years you give it to keep growing, makes it so the next 4 years kind of matters less from a political standpoint. So I'm not really worried about there being a political premium in it, even though obviously the election outcomes do matter for the asset class.
Alden's core thesis is clear. While Bitcoin's historical 4-year halving cycle still casts a long shadow over market sentiment, it's global liquidity, not the halving itself, that is emerging as the dominant force shaping price action. As Bitcoin matures into a $2 trillion asset class and integrates more deeply with traditional financial systems, its behavior is increasingly tied to macroeconomic conditions. Liquidity cycles, interest rates, and capital flows now dictate whether a bull market is brief and explosive or slow and extended. She points to on-chain data, specifically the market value to realized value ratio and hodl waves, as better indicators of where we are in the cycle. These metrics suggest we're far from the kind of frothy excess seen at previous tops. Long-term holders are beginning to take profits, but not at a pace that signals a full distribution phase. According to Alden, that's a sign the current cycle is still intact, though more prolonged and less volatile than in previous years. But despite this measured optimism, Alden remains anchored in macro reality. She warns that the fiscal picture in the United States is becoming increasingly untenable. With demographic shifts, structural deficits, and elevated interest expense, the long-term trajectory of the dollar itself comes into question. In her view, this is precisely the kind of environment that strengthens the case for scarce, high-quality assets and for Bitcoin to continue its upward march. So where does this all lead? If current trends in liquidity, fiscal deterioration, and long-term holding behavior persist, how high can Bitcoin go in the months ahead? In the next segment, Lynn Alden lays out her price targets for this cycle and explains why a move toward $150,000 may not just be possible, but likely.
But basically, it's the idea that U.S. fiscal deficits are pretty intractable. And so regardless of election outcomes, because I was saying this before and after the election, there's very few ways to meaningfully reduce the deficit in any sort of investable time horizon, so call it 5 to 10 years. And therefore, I had the view that this is going to be very persistent, and therefore the market impacts from those deficits are likely to continue. So the main metrics I look at, one of them is demographics. So as the baby boomers started entering retirement years in the late 2010s at scale, there started to be a drawdown of Social Security, for example. And we started to see a disconnect where normally fiscal deficits are higher during periods of high unemployment and they're lower during periods of low unemployment. And we got a disconnect from that. So we started to see large deficits even during periods of low unemployment. And so they're disconnected from the economic cycle because they're more tied to demographics, more seniors collecting Social Security and Medicare and paying less into the system. And so that's a fundamental change. Another really big fundamental change is the interest rate. And so for about 40 years, there was rising debt to GDP, but there was falling interest rates. And so the interest on that debt, especially as a share of GDP, was very manageable. But then once we hit zero, kind of throughout the 2010s, and we started to have more inflationary pressures. And now, even if we only go sideways in interest rates, so I'm not even necessarily calling for higher interest rates, but if we just kind of bounce around between 2 and 6 for the foreseeable future, instead of going structurally downward, there's no longer an offset to the rising debt to GDP. And so we for the first time in decades, we got to break out in interest expense as a share of GDP. And so that's a very meaningful and intractable issue to deal with. There's multiple other factors. A really big one is that the U.S. is more financialized than many other developed countries, meaning that our tax receipts are heavily correlated with our stock prices. So if we get like a bad or even a mediocre year in the stock market, with a lag, like the next year, generally speaking, tax receipts are not very good. And that's for a couple reasons. One, we have more wealth concentration than most other developed countries. There's more global capital stuffed into our stock market. We have, a lot of compensation is tied to stock prices, especially among high income, which pays the majority of taxes. And of course, capital gains. So all these factors together makes that pretty strong correlation. So that means even when they do try austerity in some way, like they try to trim spending or try to increase taxes, it's likely it's likely to translate to kind of worse stock performance, which then ricochets back and hurts your tax receipts. So basically where they are, this whole debt cycle, where they are in demographics, and then the highly polarized Congress that kind of makes major tax increases hard and makes major spending cuts hard. A lot of this is just locked in almost regardless of election outcomes. And so for the next 5-10 years, I think this is going to be a background issue that both in terms of the economy and in terms of capital markets will be relevant. And of course, Bitcoin, the reason Bitcoiners should pay attention to it is because the main competition of Bitcoin is the dollar. And so if the dollar is very strong, then it makes the case to own it. But if the dollar, if total credit in the system and total dollars in the system are going to keep increasing over the next 3, 5, 7, 10 years, that's one of the macro factors that makes Bitcoin useful to own. You want to own scarce assets if you're in kind of a slow motion runaway fiscal spiral. Bitcoin, gold, high quality equities priced at reasonable valuations, high quality real estate priced at reasonable valuations. Generally speaking, I like the global assets the best. So that's Bitcoin and gold. And between the two, Bitcoin's the faster horse by far.
What if are we underestimating the resilience of the fiat system? What if, for example, technology could come into play with technological deflation? So when technology improves, things get cheaper. Wouldn't that invert the trend you're talking about?
it's not going to slow down the deficits. Technology does have other impacts on, for example, where inflation shows up from those deficits. If you don't get a lot of technology offsets, then those deficits are likely to show up in consumer price inflation. So, for example, if we're not better at making more energy, if we're not better at making more productive things related to AI and things like that, then those deficits are likely to show up in price increases because our supply is not keeping up. On the other hand, if AI suppresses white collar wages, allows way more white collar output for things, if we keep the energy flowing and things like that, then those fiscal deficits are more likely to show up in asset price inflation. And so either way, if the number of dollars is increasing substantially, you want to own the highest quality scarce assets. So if for example we have no bottlenecks in energy, it doesn't necessarily follow that oil is going to go up in dollar terms, even though there's a lot more dollars, say 5 years from now, than there are now. On the other hand, if that's happening, we're not making more Bitcoin other than the marginal amount that's still being mined. And so the highest quality assets, whether it's Bitcoin, gold, the best equities, best real estate, the best, irreplaceable art, waterfront property, those types of things, they're still likely going to appreciate relative to dollars in that system where total credit keeps growing. That whole structure is almost disconnected from technology. And so technology just kind of shows up where that price increases are likely to happen.
And now, final question, Lynn. I want to know your price outlook for the next few months. Do you have some price targets that you're looking at in terms of how higher we can go from here in terms of Bitcoin price?
I think it'd be disappointing if we don't see at least 150K. I'm hesitant to give a much higher price targets because you could certainly reach there, but I try to take, one step at a time. And so I think that by most metrics, I'd be surprised if we don't see another 30+% move or more that would get us up to that kind of that higher level. There are certainly higher numbers that I wouldn't be surprised at all. I'll reassess if we reach those numbers to see if there's still more to go. But basically, I think we're in a longer cycle, maybe less extreme, but still, summers and winters, still bull markets and bear markets, and I tie them less to the 4-year halving cycle and more toward pockets of euphoria, pockets of depression, as well as the supply-demand cycle. So what kind of higher prices unlock older coins, and what kind of consolidations stop those older coins from getting to the market? I'd say most metrics suggest higher from here, at least moderately.
Lynn Alden's analysis stands apart because it grounds crypto's volatility in structural economic realities, not just sentiment-driven cycles. Her thesis, that the 4-year halving cycle is losing relevance, comes from years of observing how Bitcoin responds to liquidity, not just issuance changes. And as the asset class matures and institutional capital deepens, the relationship between Bitcoin and broader macro conditions only strengthens. Among the key indicators Alden watches is the market value to realized value ratio, also known as MVRV. This metric compares Bitcoin's current market capitalization to the aggregate price at which all coins last moved on-chain. When MVRV reaches extreme highs, as it did in late 2017 and early 2021, it signals euphoric sentiment and overvaluation. But Alden notes that we're not there yet. Current MVRV levels remain moderate, suggesting there's still room for upside before we risk entering speculative excess. She also tracks HODL waves, a metric that visualizes the age distribution of coins. During the early phases of a bull market, coins that haven't moved in over a year begin to sell into strength. That's exactly what we're seeing now, a gradual distribution by long-term holders, but not an overwhelming flood. This pattern is consistent with mid-cycle behavior, not late-stage blow-offs. Compare this to Willy Woo, another respected on-chain analyst who also uses MVRV and a suite of proprietary indicators like the CVDD, Cumulative Value Days Destroyed, and Bitcoin Cost Basis Density Maps. While Alden favors macro frameworks, Woo blends on-chain flow with behavioral psychology. He's recently argued that Bitcoin has entered a phase of smart money accumulation, where institutional players are quietly increasing their positions without retail froth. Woo's own long-term models, like his top cap and long-term holder supply ratio, also suggest that we're not near the cycle top, echoing Alden's views. However, Wu leans slightly more bullish in his timing, suggesting that capital inflows and ETF demand could accelerate the second leg of this cycle more quickly than previous ones. Alden, by contrast, takes a more tempered view, believing the cycle could be longer and smoother as liquidity normalizes rather than spikes dramatically. Where they align is in their core conclusion: Bitcoin is still in a structural bull market, underpinned not by hype, but by a weakening fiat regime, persistent fiscal deficits, and growing institutional interest in scarce, programmable assets. And that brings us to her price outlook. Lynn Alden's base case: Bitcoin reaching at least $150,000 this cycle would be a reasonable expectation. Not a moonshot, not a stretch, but a data-driven target grounded in historical valuation, on-chain cost bases, and macroeconomic tailwinds. She's not forecasting mania. She's forecasting progression. A continued revaluation of Bitcoin as a legitimate store of value in a world of debased currencies and structurally unmanageable debt. This isn't just about price, it's about positioning. In a world where dollar strength is fragile and political risk is slowly being priced out of the crypto market, Bitcoin is becoming a mainstream macro asset, no longer on the fringe, but embedded in the financial system. What's your take on Lynn Alden's framework? Are you in the Willy Woo camp of accelerated upside, or do you agree with Alden's more extended cycle thesis? Drop your thoughts in the comments. We read every one. If you found this breakdown valuable, take a second to like the video and subscribe for more in-depth, data-driven coverage of crypto markets. We dive into macroeconomic trends, on-chain analytics, and expert interviews to help you stay ahead of the curve. And if you want to stay informed about the intersection of crypto, macroeconomics, and institutional behavior, this is the channel to follow. More expert insights are coming soon. Thanks for watching.